Good day, viewers. I'm Binette van Wyk, Head of Distribution at Catalyst Fund Managers, and this morning I'm joined by Zaman Kambendi, an investment analyst of our Catalyst Global Real Estate UCITS Fund. Our global investment team recently attended the Kempen European Real Estate Conference in Amsterdam in May, as well as NAREIT's REIT Week conference in New York City in June. In today's dashboard update, we will be sharing some of the key takeaways from both these conferences, as well as an outlook for the global listed real estate sector. Sama, welcome back from New York. It's great to have you back. Sama, I think the first 6 months of this year have proven to us that we're still in an environment where macro factors are dominating and there's a lot of market volatility and uncertainty. I'm sure that these 2 points, as well as many others, were some of the key things that were discussed at both these conferences.
Yes, indeed, Vinette. Thank you. The volatility that we've seen in the first half of the year has really resulted from various factors, including inflationary pressures, central banks' monetary policy decisions, and the stress that we've seen in the US and European banking systems in the Q1 period. The cost and availability of debt were hot topics at both conferences, as the language around further interest rate decisions does not indicate a halt in interest rates just yet. With cost of capital becoming more expensive, uncertainty over asset values, as well as the lack of transaction activity in the market, balance sheet health remains a key focus for us as investors and real estate operators alike.
Sama, let's then take a moment and actually focus on balance sheets. I think it's actually quite positive to share that if we look at balance sheets of the companies that we invest in within our global listed real estate fund, the balance sheets on average has LTV levels sitting at like roughly 29%. The majority of that debt is actually fixed, sitting at 86%, which is fixed, and then an average term of maturity of roughly 6 to 7 years. These attributes as a whole obviously insulate REITs against looming market pressures as growth is slowing and you've got lending conditions which are tightened. Now, that being said, where are REITs looking for funding and what does recent corporate raising activity look like?
In these tough financing conditions, many REITs have expressed a preference for sourcing bank funding, where generally lower credit margins are available currently relative to the unsecured markets. However, even with this optionality, we have seen capital raising activity decline in the last quarter as REITs have become more cautious and willing to wait on some potential reprieve from central banks' monetary policy decisions. As you've said, Binette, many listed companies seem to have better access to bank funding as a result of their capital management programs relative to their private market peers, who are facing more pronounced leverage issues and more scrutiny from banks who are tightening their credit criteria. Some companies have mentioned that they're looking at dispositions for additional financial flexibility in meeting their near-term debt obligations in the absence of favorable refinancing conditions. However, transaction opportunities are far and few between as wide bid-ask spreads are persistent in the market.
Someone like you said, external opportunities are unfortunately dwindling. So management teams are forced to focus on internal growth opportunities. But it's difficult to weather the storm in this current macroeconomic environment, which is so tough. At Catalyst Fund Managers, however, it has always been part of our robust, detailed bottom-up methodology to look at the quality of management teams of the stocks which we invest in. So if we go back to the conferences and we focus on the quality of management and their capability to make good decisions in this environment, what are some of the takeaways that you can share with our viewers?
Correct, Binette. As you've mentioned, we are in a tough operating environment currently, which means that more management teams that have more levers to pull for internal growth are positioned better in these environments. At the NAREIT conference, comments about market selection and portfolio positioning suggested that the East Coast and Sunbelt markets were holding up better relative to the West Coast. The Sunbelt has continued to benefit from significant in-migration since the onset of the COVID-19 pandemic in 2020, with positive population and job growth prospects to support the underlying fundamentals. On the West Coast, however, we're seeing pockets of concern including Seattle and some markets in the Bay Area where near-term growth looks sluggish. This was echoed in many meetings hosted by office and residential operators at the conference.
At Catalyst, our global investment team aim to attend 6 to 8 industry conferences per year. At these conferences, like Zama, you guys get the opportunity to interact with executive management teams of most of the companies in the universe of stocks which we invest in. At the Kempen and the NAREIT conference, our team members got the opportunity to interact with more than 80 management teams across more than 20 subsectors within the global listed real estate sector, and you get to interact with local market participants. Zama, in summary, what are some of the key takeaways that you would like to leave with our viewers today?
The Kempen and NAREIT conferences gave us valuable insights into the funding, internal and external growth opportunities that the real estate subsectors face today. We walked away from the conferences generally quite comfortable with the resilience of earnings in most of the subsectors, except for offices, which continues to face significant headwinds that concern us as investors. All things considered, I think we are comfortable with the recent adjustments to our assumptions and sector outlooks for most of the subsectors ahead of Q2 earnings results, which will be released in the coming weeks.
So, and then last but not least, what's your outlook for the global listed real estate sector?
Based on our earnings assumptions, as well as market break-even inflation expectations, we believe that the real estate sector is fairly valued. Within the real estate universe, there are attractively priced opportunities that provide us as astute active managers with the opportunity to generate some alpha for our clients.
Zama, thank you so much for your valuable insights that you shared with our viewers today. Viewers, thanks for tuning in. If you'd like to learn more about the global listed real estate sector, please refer to the full Q2 2023 global dashboard, or alternatively, please reach out to me as per the contact details below. Thank you for your time and goodbye.